Welcome to Bunnex Investment Group. Would you like to simplify your analysis process? Do you need a few steps to get an entry? Or do you want a strategy that will give you a positive reward to risk ratio, whereby you get 2 to 1, 3 to 1, and so forth? If your answer is yes on the above questions, you need to watch the whole video as we unfold the great EMA only strategy. Firstly, we need to highlight that when the market trends to the upside or downside, we experience higher highs or higher lows. Basically, higher highs or higher lows, whereby we are going to the downside. In an uptrend, profit is made on entries on lows, and the vice versa is true. In a downtrend, profit is made when we enter on highs. However, these points are difficult to get in, and we can simplify them by use of exponential moving averages. We will need to employ what we call the EMA theory that simplify the whole process. So the EMA theory, which simplify how we enter, states that whenever two EMAs crosses within the right market context, expect to see a pullback of the market to the higher period EMA. For instance, if I just randomly pick 9 and 21 EMAs, if these two crosses, the EMA theory is telling us that when this 9 and this 21 EMA cross, let's say this is 21, period 21 and period 9, when they cross, we expect to see the market to come back and retest the highest period. In this particular case is the 21 EMA, and continue with the prior trend. Therefore, we'll need the following indicators within our strategy. We've said our EMA strategy will only use moving averages. So these are the moving averages that we need, and all our exponential moving averages applied to close. We have 5, we have 13, period 50, period 200, period 800. We need to have different colors for each and every EMA so that it will be easier on how we see these EMAs on our charts. So we now need to illustrate all this on real charts. But before we see examples, please note that we have a free Telegram channel where we share free signals, free setups, and trading tips. Be sure to be part of that community. So this is pound against the dollar. We are going to illustrate how to use the EMAs within this particular strategy. I will actually start by defining all the EMAs on my chart. We have the 5 in yellow, the red in is 13, the 50 in blue, the 200 in white, and the 800 in dark blue. Basically, we've said whenever we see two EMAs crossing each other, we expect to see the market to pull back to the highest period EMA. So when we are back testing, we are going to look on each and every crossover and study where we were going to make an entry. The first crossover that we can see of significance is or starts with the 5200 EMA. The 513 and the 1350 are not significant. The first one will be the 5200 EMA cross. In this particular case, after this, applying the EMA theory would say the market should pull back to the 200 EMA, like what we've just said. Unfortunately, the market did not pull back to the 200. When the market went on, it gave us another EMA crossover. This was now an 800-200 EMA crossover. We've said the market will always try to pull back to the highest period EMA. In this particular case, we can see that the highest period is the 800 EMA, and that is where the market will try to pull back and retest before continuing with the trend. As you can see, the market came to retest the 800 several times, and we can see that the market made a trend. So after an 800-200 EMA cross, the next crossover should be a 5200 crossover, but now in a different context. Therefore, this will not hold because it's still in the first context of the latest crossover of the 200-800 EMA. So in this particular case, this was invalid, and then this was now in opposite of the latest context of the 800-200 EMA cross. We are saying in simpler terms, when we see a 200 EMA crossing the 800 EMA to the upside or to the downside, the next crossover after that crossover, after the 200-800, will need to be in opposite of that latest cross. So we've seen that there was a cross to the downside. So a 50-200 cross to the downside was no longer valid because this was available. The next point was now a 50-200 EMA cross, which is this one. So from the 250 EMA cross, we can see the market coming back to the higher period EMA, which is the 200 EMA, and it went to the upside. After that, we can see another 800-200 EMA cross, but unfortunately, the market did not give us a candlestick reversal pattern on the 800 EMA. Someone would say I could have entered, and that's still fine, and it could end up as a loss, and we always say there is no strategy without losses. After this 200 to the upside, our next will be now a 50-200 in the opposite direction. A 50-200 was issued here. We were waiting to see the market to come and retest the 200, but unfortunately it did not. In this particular case, the 800-200 crossed, meaning that we were now expecting to see the market to come to the 800. The market came to the 800, and unfortunately the market hasn't moved enough, but it's actually still in the rightful market context like that. So basically that is how you use the EMA only strategy, whereby you'd apply the EMA theory. On that note, we've come to the end of our today's video. Like and subscribe, and I'll see you in the next one.